Evening, everyone. I hope, thanks very much for joining, those of you who've joined, and for the webinar on climate risk. Looking forward to tonight. We'll give it people just another minute or two before we get going, and then we'll get going. So. Conscious is also 7 p.m. local time. So we'll give just folks another 30 seconds and then we might get going. Good to see some friendly faces joining. All right, I think we're probably now's about the right time to get going. So thank you very much for everyone who's joined up and also for making it the non-standard time of 7 p.m. local. But it's also great to have our friends from Europe in. So I'll introduce those guys in a sec. Quick bit of housekeeping. We're looking here tonight or this morning, depending on where you are sitting, at climate risk in Australia, and in particular how it might affect banks in the country. If we can just go, I suppose, just to the first slide, Catherine. I think you've got the details. So quick, just sort of bit about us, and I know that our friends from Mitiga are going to do the same thing as well. But a quick just bit about Sustain2050, who we are, what we do, and then a quick bit on our partnership with Mitiga. So Sustain2050, who are we? We are all, the team is all climate risk and ESG ex-banking. So we do really three things. We do climate risk, we do climate disclosure and climate literacy, all from a consulting side and also from a product side when we partner with folks like Mitiga. We've worked with some of the customers we've worked with are down there, but essentially very much our business is very much a banking heavy business. But what I'm really going to do, I suppose, for the first part of tonight is really hand it over to Mitiga. We're going to be really talking about two different things on the session. So the first thing is, as I said in a lot of the communications to everyone, this is really a session to introduce the experts in the room, which is, of course, well, Catherine, who you're going to be introduced to in a second, and Jake from Mitiga. Mitiga is the climate risk modelling firm that does all of the very, very heavy lifting when it comes to the quantitative side of climate risk analysis. And we partner with them for all of the work that we do with our climate risk customers. But I suppose what I'm going to ask is, Jake, can you quickly introduce yourself, introduce Mitiga, the business, and give us a bit of a flavour of what we're going to hear tonight, please.
Sure. Thank you so much, Joel, and welcome everyone. Great to connect with you. So I'll let you read the quote here from the World Economic Forum from last year in the CEO's Guide to Navigating Climate Risk. But this also relates to another ongoing trend that most are aware of. So I lead partnerships and growth here at Mitiga, and I'll get into a little bit more about what Mitiga is in the coming slide. But for the long and the short of it, one of the conversations that I was having recently with one of the Microsoft leaders who are heavily invested with us, and we work closely with them as well, is that in the next couple of years, there are going to be two types of companies, one that is AI empowered and another that doesn't exist. I would argue, perhaps a little bit controversially, that the same is true for organizations. The need to integrate climate risk into the enterprise risk framework is a necessity. Ben Bernanke in the US has called this out recently as a systemic risk in the mortgage markets. In the UK, the FT, the Financial Times, did an in-depth report in the last 6 to 8 weeks on the next financial crisis, and that is related to climate. So the risks that are inherent here are absolutely critical for us as leaders to be able to incorporate throughout our operational processes and our strategic planning and our vision. So I think a lot of us are aware of this. This webinar today is to dive in deeper on how to make a little bit more sense of this and what it actually can mean for you and your business. So Catherine, if we jump to the next slide, a little bit first about Mitiga. So we are based in Barcelona. We are globally distributed and very much backed by a diverse group. You will see some there in the financial services space that are backing us. It's no surprise why Nationwide or Mahmoud are backing us, because they're trying to quantify the risk at an insurance level so they can better serve their customers, right? But we've got a deep scientific expertise, physics-backed, spin-off from the Barcelona Supercomputing Center, and leveraging AI, certainly, but also downscaling the global climate models to make them more digestible in terms of trusted and transparent methodologies and models to be able to allow you to depend on those for your business and your risk assessments. So this is a little bit of a snapshot of who Mitiga is. We can dive in deeper, and Catherine will touch on these a little bit more. If we go to the next slide, I'll just end this and then turn it over to Catherine to give you a little bit of an update on how we do this, working in conjunction with Sustain2050, who are the experts in the banking sector and in the Australian market in particular, where we are expanding quite rapidly because of these systemic risks that exist. So the use cases are very diverse, and in concert with that, our platform and how we deliver our insights can also be very diverse. So it's either through a SaaS offering with a nice UI, it can be through an API or through data sets or custom insights if you're looking at custom hazard maps and trying to get in deeper down at an operational level with the actual asset and physical asset that is at risk. But you can see on the right, below the surface, the number of different risks that this brings up in the value chain goes very, very deep. And it's about quantifying and better understanding that risk that we'll dive into here today. So with that, I'll hand it over to Catherine, who is one of our senior climate risk experts, to talk you through a little bit more in detail of how it is that we approach this and what some of the important things to keep in mind, especially as it pertains to your business in the Australian market. Catherine?
Thanks very much, Jake and Joel, for the introductions. So we have probably about 25 minutes now, and I'm going to run you through 3 parts in this presentation. We'll start off with a whistle-stop tour of Australian climate, looking back in time, then looking to present climate conditions, and then thinking about how we can look into the future, essentially. Then we'll have a look at what climate hazards that we are looking at in more detail in Mitiga. And then finally, some climate hazards which are specifically relevant for Australia, specifically relevant for the residential property market that we're interested in here. So as Jake mentioned, I'm one of the senior climate risk people here at Mitiga. I'm actually a climate scientist by training, also engineer. So what I wanted to show you first, as I mentioned, was a look really back in time at Australian climate. So we're going to start 60 million years ago, which is very much back in time. So you can see from this map, it's just showing the locations of the continental land masses and also the ocean depth over time. So we can play it forward and see what's happening. So India is moving north. Australia starts to disconnect from the Antarctic continental landmass, it's drifting north. Continuing drifting north, the Atlantic's opening up, the Pacific is reducing in size, and Australia now has reached its present-day position. What's important to know about this is that the global climate is a result of the Earth system. So we have the rotation of the Earth, the ocean currents, which are determined by the continental landmass and ocean circulation patterns, and then obviously atmospheric circulation, which is going to give us essentially the weather and climate conditions that we're experiencing on the ground. So just another look here at this 60 million last years. Here now is the global temperature indications over time from scientific data. So we can see the 60 million years ago, the Earth was probably about over 10 degrees warmer than it is at present. But at this time, the interior of Australia, the estimate is that it was about 5 degrees warmer than present. And this is because Australia was in much higher latitudes. So it was relatively cooler, but with a warmer global climate, we still have a warming compared to today. So if we now go to about 14 million years ago in the Miocene, the temperatures are about, let's say, 4 degrees warmer than present, which is what we might consider to be what we might expect end of the century under bad scenarios, let's say. Here, Australia is approaching its present day position. We're not quite there yet. If we go to about 1 million years before present, we're starting to see the onset of the glacial interglacial cycles. So we can see large differences between the cold periods where we have extensive ice sheets over the high latitudes in both hemispheres. And then finally, let's go to something approaching the present. Australia is in its present day position, and we can see from 20,000 years ago, we're coming into the Holocene, which actually starts 10,000 years ago. This is the period of time where we can see the expansion or let's say expansion of human civilization, agriculture, towns, cities, infrastructure. These are the kind of conditions which we're all used to. You can see right at the end of this graph, there's 2 points in time, 2050 indicating what possible temperatures we might have in 2050, about 2 degrees warmer than what we were used to over the last 10,000 years, or 2100, perhaps over 4 degrees warmer. So these two things are happening much, much faster than changes we've seen in the past. So we know these things which are governing the climate system. But if we then add in the anthropogenic effects, this is what we're really concerned about now, is these really fast changes that we're driving through greenhouse gas emissions and land use change. Okay, so now we're in the present. So let's look at the climate zones of Australia. So these zones are defined by temperature and humidity. So you can see in the northern part of Australia around the coast, there's hot, humid summer or warm, humid summer conditions. We go a bit further to the south, we're getting into hot, dry summer, mild winter. The central part of Australia is really dominated by more desert-like conditions. So hot, dry summer, cold winter, very extreme conditions. We go to the coastal areas to the south. Now we're coming towards warm summer, cold winter. And in some areas in mountainous zones, we can have, mild, warm summer and a cold winter. So another way of looking at these climate zones is splitting them into climate types. So again, we start at the north, equatorial conditions in the far northern tip, a tropical zone also in the northern part. As we know, these are in what I showed you about the latitudes. The northern part is very much in this equatorial zone, and the southern part not, because Australia is a very big continent. So coming from the tropical zone, we have some subtropical areas in the middle latitudes in Australia. The central part is the desert area with a kind of ring of grassland around it, and then temperate zones towards the south. So because of these climate zones, it's not a surprise that most of the urban areas and the big cities are located around the coastal areas of Australia. And really, this is a result of the climate conditions on the ground. These climate conditions are defined as the average conditions over a 30-year period. This is what climate means. So these particular ones are showing you the 1961 to 1990 average conditions. So we're already perhaps moving slightly away from that, but these are the kind of things that we have all got used to, and also the infrastructure and development in Australia. These are the things, this is the kind of climate that was the baseline for all of these developments. I hope that makes sense. So moving from the general 30-year climate to looking at variability. Year on year, we know there's variability between, in this case, rainfall. So now we're moving away from average climate to the kind of extremes that we'd be interested in if we're considering risk and exposure to climatic hazards. So as I mentioned, this is showing you the annual total rainfall year on year. And this is from 1970 to 2024 with under each map, there's the year marked. So for example, we can have a look at some of these years. 1970, that was a particularly dry year, fall drier than average. We can see 1974 was a very wet year on that first top line. But if we fast forward a bit to 2019, it was a very, very dry year. And this is coinciding, and it's coinciding, not coincidentally, with the terrible 2019-2020 fire season that Australia experienced, these catastrophic events. So the point here to make is that because of this climate variability, on the ground, depending on location you're in, year on year, you're going to be experiencing different conditions. And it's from this variability we can start to understand the extremes and start to statistically consider what is the exposure to particular hazards on the ground. So similarly, looking at temperature in the same way, 1970, pretty average year. I mentioned 1974, which is a very wet year, and here it was also a cool year in relation to the other years on this record. And again, can look at 2019 with the terrible fire season. This was also a very hot year, and probably one of the hottest on records according to these maps from 1970 to 2024. Again, this isn't a coincidence. The very dry, very hot year was the thing that really was driving the terrible wildfire season that was experienced that year. I think another thing that maybe starts to come out from looking at the temperature variability over this time period is that most of the hottest years look to have been happening in the last 10 years. And this also isn't a coincidence. It's because now we can start to actually measure the effects of climate change. So we can start seeing it, we can actually see it in the records. Okay. So this is over a similar period. It's showing you the years from 1995 to 2024 and showing the insured losses over that time period. So the insured losses from declared insurance catastrophes have grown historically from 0.2% of GDP in 95 to 2000 to 0.7% in 20 to 24, with floods, expanding development and urbanization being the main drivers of losses. So this is relating back to what I was talking about with variability and the extreme events, which is what we're interested about for risk. Over the last 30 years, there's been an increase in the losses as a result of these extreme events. But one thing to note here, this is also, we're talking about hazard, particularly flood, but also the expanding development, urbanization on the ground is also something which is feeding into the vulnerability, which is going to be contributing to the loss. This figure is taken from Australia's National Climate Risk Assessment, which was published a few days ago, which is a really good comprehensive view of Australia's exposure to climate risks on the ground, and I recommend everybody to read it. I'll be referencing this in later moments in the presentation, but I'll try to call it NCRA to shorten it a bit. Okay. So what we were talking about before was the present climate, present conditions, things we can measure. But if we're talking about future climate, we need another way of considering how we can measure the risk. So the way this is done is by using global climate models. So what I'm showing you here is an example of the different mechanisms in the Earth system which are going to be contributing to the climate, which is going to be contributing then to essentially weather conditions and these extremes on the ground. So, for example, we include solar radiation, the impact of biogeochemical cycles, the ocean circulation as well, the carbon cycle, the cryosphere. All of these elements are modeled numerically based on fundamental physics and also on sometimes empirical data. This is the wealth of information that we have gathered about the Earth system over the last, let's say, 100 years. So if we take the globe and split it into a three-dimensional grid, where we're also looking into the ocean and up into the atmosphere, at each grid square, or cube, I should say, these mechanisms, the mathematics of these mechanisms are solved. And so it means that we can trace the exchange of energy and matter between each of these grid boxes over the Earth system. And by doing this, we can we can model the impact of anthropogenic emissions on the Earth system. So we can essentially do future projections to see what the likely response of the Earth system is to anthropogenic forcing and also natural forcing. So the way this is done is by having many models which are doing the same job. So there's 35 research centers, for example, who have these global Earth system models, all part of the CMIP project. CMIP is the Coupled Model Intercomparison Project, where the different boundary conditions and model conditions all match each other. So these models can run, and then we can compare all of the results of these models. So we end up with an ensemble of climate models to try and understand what the future might look like. And it's these models which are informing the IPCC and guiding policymaking. There's also these models that we use as a basis for our climate protections and climate hazard information at Mitiga. Okay, so just to step back right now to have a very brief overview of the definition of climate risk. So risk is a combination of several factors, which include the hazard that we're talking about, the exposure to the hazard, and the vulnerability. So the hazard is going to be like the extreme wind speed, perhaps. The exposure is going to be your particular location on the ground and how it's experiencing extreme wind. And then probably, let's say, a really important part is the vulnerability. If you have the extreme wind in the middle of the desert and there's nothing there, then we don't have very high risk because there's nothing that is going to be damaged. But if we do have, let's say, buildings in that area which are vulnerable to the impacts of extreme risk, then we have a high extreme wind, then we have a higher risk. So I'm going to be mentioning risk, exposure, hazard, and vulnerability in later slides. So this is just to know where it comes from. Risk is the culmination of all these factors. Okay, now just a very, very quick overview of Mitiga's science that we use on Earthscan and the data that's provided through Sustain2050 to you. We use an ensemble of CMIP6 models and extensive observational data sets, which create the climate predictions until 2100. So I sort of mentioned something about this before. We also use advanced statistical methods to model the extreme values and provide probabilistic measures as return periods. So this is talking about how exposed your asset is depending on the risk level that you're interested in. I think I'll come back to return periods a little bit later. We assess your asset's location's exposure to these hazards, including uncertainty measures, and provide ratings, which can quickly show you which assets are more at risk in your portfolio. We also finally provide climate value at risk for built assets specifically, and these are currently 4 acute hazards, which is flood and extreme wind. So a very brief summary of our climate science. We focus really on science that you can trust. We don't have black boxes at Mitiga. We make sure that we understand exactly what is going in and what's coming out, and we can explain that very clearly so everybody can have confidence basically in the science that we're providing. I mentioned return periods before. For example, if you're interested in the average kind of conditions, you might want to be looking at the 2-year return period, which means every 2 years you might expect this particular level of exposure to that hazard. But if we're looking at higher risk scenarios like a 100-year return period, which means 1 in 100 years, you might expect this level or the 1% annual risk. We also provide that. So we have a whole range of return periods. And then finally, we obviously do validation of our scientific data, which is also feeding back into this aspect of having confidence in the data that we're providing. So this is a very quick look at Earthscan. Here you can show the 3 scenarios. We also have a range of hazards and also provide data in 5-year chunks over time. And you can see here an example portfolio. You can change the hazard and get hazard-specific ratings and information for your whole portfolio. This information is provided through Sustain2050. So I don't know if anyone here is actually using the platform, but this is what the platform looks like. It's the same data that we provide, but this is just maybe a nicer way of presenting it for this presentation. So a quick word on uncertainty and why it's super important. As I mentioned before, we use a multi-model ensemble to estimate the uncertainty associated with each hazard for the future, because we don't know exactly what the future is going to look like. So aside from looking at the different future emission scenarios, we also look at how our models are telling us about how each hazard might change in the future. So here's an example looking at heat waves for this particular portfolio in Australia. So if we look at the line in the middle, which is the average of our climate model ensemble, we might say at 2020, we might expect 4 heat wave days, according to this measure, but by 2100, it might be 10. But you can see there's an upper uncertainty bound, which is suggesting some models are maybe saying there might be 20 heat wave days, 2100. So I think this is a super important point if we're thinking about risk. It's not just about looking at the mean value that the models are telling us, but actually considering, are we going to be lucky or not? How do we know if it's going to be the model that's responding faster or more sensitive? Maybe that's the model that better represents the system. We're not sure, but this is why we're providing this uncertainty level, which I think is a super important point. Okay, so now let's move on to thinking about hazards and how Australia is particularly impacted by different specific hazards. So this is an overview from Bureau of Meteorology and CSIRO. I'll just read through them. Sea level rise projected to continue, coastal floods to become more frequent, marine heat waves to be more frequent and intense, climate to become warmer, more heat waves and fewer cool days, snowfall, snow cover and snow depth to continue decreasing and snowmelt to increase. The impact from storms will be amplified by higher sea levels and heavier rainfall. Cool season rainfall decline in southern and eastern Australia will continue in most places. Heavy rainfall becomes more intense, particularly hourly and sub-hourly downpours, and a longer fire season and more dangerous fire weather is what's projected for the future. Coming back to the NCRA assessment and thinking specifically about the impact of these changes on residential infrastructure. This is a table that I found in that report. One thing to mention, the way information is presented in this report is slightly different to how we present it from Mitiga, and especially in Earthscan, is here they're talking about global warming levels, whereas we are referring to the emission scenarios. So, okay. So the global warming levels are saying, if you experience this level of warming, we think this is going to be the impact. If we're looking at the actual emission scenarios, what we're trying to do is say, at which point in time are we expecting a certain amount of warming? So here, we're talking about the exposure to warming levels, but not necessarily pinned to a specific point in time, which is still important, interesting information. And maybe if we're thinking about the time scales of mortgages, maybe it's fine to look at it like this, because you still need to know the different levels of exposure. But one thing I wanted to mention about the global warming levels is that according to the Paris Climate Agreement, staying below 2 degrees was considered absolutely essential to avoid the worst impacts of climate change. And actually, since the Paris Agreement, it was clarified that actually staying below 1.5 degrees is really what we want to do. So the Paris Agreement is supposed to keep us below the 2 degrees. Anything outside the Paris Agreement could get to 3 degrees, so it could start being exposed to these kind of warming levels. And according to this analysis, that would be like perhaps from the middle of the century onwards, there could be a 3-degree warming. And again, bear in mind what I said about the uncertainty in projecting the future climate from climate models. It could be that actually the Earth system is a bit more sensitive than the model mean ensemble, and actually maybe 3 degrees is something that we might need to plan for. I hope not. So let's have just a very quick look closer at these numbers. So the present warming levels, which is plus 1.2 degrees Celsius since the industrial period, 8.2% of residential buildings nationally are in high-risk areas, and 8.7% are in very high-risk areas based on communities and the multi-hazard risk index. So here we're considering a whole multitude of hazards. At 1.5 degrees of warming, as I mentioned, is considered still the safe level in terms of the Earth system. Excuse me. 10.2% of current residential buildings are in very high-risk areas. We go to 2 degrees, that rises to 11.1% in very high risk areas. And at 3 degrees, this raises to 13.5% in very high risk areas. An important thing to point out as well is that adaptation against these climate hazards can reduce some of the vulnerability up to a certain point. So it's very important to also consider adaptation measures. So on the next page, I'm going to zoom in on some of this other information, which I didn't tell you. It's a direct quote from the text. The direct impacts of riverine flooding, coastal inundation, forest wildfires and windstorms and ground subsidence in drought could more than double the number of properties considered high risk, mentioned before. And by 2100, and 1.5% could see insurance premiums rise to the point that their property value declines by 10% in 2050. So this is quite serious, especially if we're thinking of the banking sector and the impact that could have. So a final point about these kind of considerations is that the emission pathways that we're on, as in the amount of emissions, the total amount of global warming levels, which are based on socioeconomic choices and political decisions, and combined with adaptation measures, both these things together are going to affect your assets' exposure to climate hazards and the risk levels associated with it, and therefore the financial and material impacts. The best way to reduce these impacts is really to have a lower emissions future to avoid the highest levels of global warming. And you can see that even from the previous table at 3 degrees C, the impacts are much greater than at 2. So this is what I would say would be one of the aims, not only about adaptation, but still about mitigation, trying to make sure that we don't reach the highest warming levels. Okay, so let's have a look at some hazards a bit more closely. Our data that we provide on Earthscan and to Sustain2050 are hazards tailored to built assets. We have ratings for each asset in your portfolio. Damage estimates are for wind and flood events, as I mentioned before. The 3 future emission scenarios for the years 2070 to 2100, and we have a suite of return periods to respond to risk level needs. I mentioned all that before. So the list of hazards that we provide are for flooding, which is riverine and coastal flooding, wind risk, which is the maximum wind gust that you might expect in a year, heat stress, which is a combination of the maximum annual temperature per day, and also heat wavelength. We have a precipitation risk, which is talking about extreme precipitation events, droughts, which is the number of consecutive dry days, the periods of consecutive dry days, I should say, and then wildfire, which is a combination of various other hazards. It's exposure to wildfire risk. So from the NCRA assessment, we also have a list of hazards which are considered critical for Australia in terms of all the infrastructure, economic activities and natural systems. So if we want to think a bit more closely about residential property, we're going to have a very quick closer look at these 3, flood, sea level rise and wildfire, where all 3 of them can be impacting the value of the property and ultimately therefore have an impact on the banking sector. So let's start having a look at coastal flooding. The hazard is as a result of sea level rise and storm surge. So obviously sea level rise is going to rise the level of the sea in general. Storm surge is a result of low pressure areas which kind of bulge the height of the sea at the coast. And you can maybe have high winds as well, and all these things result in coastal flooding. So in the present day, there's already coastal flooding, but in the future, with increased sea level rise, the amount of coastal flooding is projected to increase. So again from the NCRA report, in the present conditions since 1880, we already have 20 centimeter sea level rise. If we look at the lower global warming future, an additional 14 centimeters projected. We go to 3 degrees warming at the end of century. The projection is 54 centimeters increase. So these then feed into the coastal flood hazard. So the frequency of coastal flooding will increase in line with the sea level rise increase. An interesting thing to notice is the planning benchmark is very, very much higher than these risks, which makes sense because we want to plan against these things. So new properties which are being built will not be built in the places that we know really are at risk. But of course, this is only applying to new properties. Properties which are already built and already exist are still going to be susceptible to this hazard. So the vulnerability in this case, specifically for Australia, is there's lots of coastal towns and cities. As we mentioned before, most of the urban areas around the outer coast of Australia, not in the central part. Just a little quote here. Sea level rise will intensify coastal flooding and erosion, exacerbate flood and tropical cyclone impacts, and increase the severity and frequency of extreme events. These changes will notably increase insurance costs, leading to more underinsured or uninsured properties. So a final note here, and something which was mentioned in the NCRA report, is that low probability but high impact events, such as ice sheet collapse, will result in greater sea level rise and knock-on impacts. So this is something, as I mentioned, is written in that assessment report. It's worth bearing in mind. Let's move on. So the next hazard that we're going to have a closer look at is extreme precipitation, which is the thing which is going to be driving other types of flood. So here I'm showing you a map of Australia, which is shaded according to the change in mean precipitation and how sensitive it is to global warming levels. So there's a scale of -10 to 10. This is in percent, which means that per degree Celsius increase, this is the impact it will have on the mean precipitation amounts. So I think it's pretty clear when we look at this map. The interior of Australia for mean precipitation, the projection is perhaps slight increase in the mean, but then we'll go around the coastal areas and especially affecting the areas around Perth, a fall in mean precipitation levels. Also plotted on this figure is our series of bar charts, and these are looking not only at the mean, but also these extreme events. So, for example, you can see the legend up there is saying mean, 99th percentile, 99.7th, and then 1 in 10 AEP, and this is directly equivalent to the return levels. So 1 in 10 annual event probability is like the 1 in 10 year return period. And the point to make here is that the mean annual precipitation can fall whilst the extreme rainfall events become more likely. And this is what's being projected for these main cities around Australia, that even if mean precipitation is falling or staying the same, the extremes are predicted to be higher, which means an increased exposure to flash flooding, which is via surface water inundation or river overspill, which can also then lead into increased risk of landslide, which all go to damage infrastructure. Final hazard we'll have a look at is wildfire or bushfires, they're called in Australia more commonly. So this is the fire triangle. You need each three of these components to result in fire. So we need heat, an ignition source, fuel, dry vegetation on the ground, and oxygen, which is very much helped by high winds, for example. The ignition on the ground, if we're thinking about, let's say, the natural system without humans, the ignition could come from lightning strikes, for example, things like that. But actually, we know that a lot of the ignitions are caused by human activity, not necessarily deliberately. It could be like, for example, I don't know, an engine fire, something like that. Somebody having a barbecue and it catching light to dry vegetation nearby, things like that. So not even necessarily, definitely not necessarily deliberate ignitions, maybe some deliberate ignitions, but this ignition part is really also very sensitive to the human activities. The dry vegetation on the ground, as I showed you before when we were looking at the rainfall and temperature variability, when you have a very dry year, the vegetation dries out, it's more susceptible to fire. And also with high temperatures, this also dries out even further. So creating the really good conditions to have lots of fuel on the ground. Another thing which can feed into this is disease, which can then kill trees, for example, but then they stay in place and they're perfect as firewood. The wind part would be when you have windy conditions. This really helps with fire spread, unfortunately, but also helps with delivering oxygen to the fire to feed it even more. So just a quote about the Black Summer in 2019-2020, where 33 people lost their lives. By the season's end, bushfires had burned a record 19 million hectares, destroyed more than 3,000 homes, displaced tens of thousands of people, and were estimated to have killed billions of animals. So if you're thinking about the future impact, with longer periods of drought and hotter temperatures, the risk of wildfire and bushfires is projected to increase. But again, bearing in mind this fire triangle, we need vegetation, ignition, and oxygen for these three things to increase the wildfire risk. So if we just think about how this might impact property value, from a study from California in an amenity-rich area, in fire-touched neighborhoods there was a statistically insignificant change in property values. In nearby neighborhoods, however, there was a 2.2% fall. What I've seen for the case in Australia around urban areas is, in fact, wildfires didn't have a great impact on property prices because there are other things which are driving people's decisions about where they want to live. So it's not just about the exposure to climate risks, which is determining people's decision making and also determining the value of property. It could be in the future there is a tipping point for all of these kind of hazards, which might have an impact on value of property. But right now, for wildfire, it doesn't seem like this is the case. And to stress, this is amenity-rich areas. So probably in other areas, maybe the situation is different. One slightly more positive note to end on this part. Because there's awareness about the exposure to this particular hazard of wildfire, and we know the impact is so huge, there has been adaptations and, let's say, policies put in place to try to reduce the risk and also reduce the risk to human life. So, for example, bushfire prevention measures, whereby properties can be expected to consider their exposure to catching fire, basically, and also fire danger ratings information, which is available to people in areas at risk of fire. And you can see there's different categories, from moderate to just plan and prepare to catastrophic, where for your survival you should leave the bushfire risk areas. And just one little note to say, of course, this is to save human lives. This red catastrophic level, when the recommendation is to leave, it's not obviously about saving property, and obviously the animals and natural systems in the area can't leave. So this is just, the other side of the coin, but it's great that this is in place. So I think wrapping up on that points about understanding the future risks helps us to plan against it or to be able to measure the risk. I think it's the moment to hand over to Joel, and thanks very much for your attention.
Awesome, thank you. And I hope that everyone else got sort of the same sort of chills that I got when I saw some of those numbers and those visuals. But if we can just go over, I'm not going to take very long, I reckon, sort of 5 to 10 minutes, and we'll get to some sort of Q&A. Just wanted to, I suppose Jake mentioned really at the top of this, that climate risk data has lots of different use cases, but each different use case needs to be treated as its own use case. And so I suppose that's really what I want to talk about here today. And I know that many of the folks on the call today work in banking, so really speaking to the use case of using the data that comes through the Mitiga platform and the amazing science, and then really try to apply it to this use case. And so I suppose what I've said here is the where of climate risk is fundamental to its analysis, as in climate risk is very much, at least in the physical sense, is very much a location-based phenomenon, but it's also a who owns this asset and under what conditions do they, I suppose, how does the damage actually impact on the various different parties that deal with that asset. I mean, as a quick example, if a company goes bankrupt, not everyone loses their money first. Like the ATO gets paid out first, then the employees, and then the senior creditors, and finally the equity holders. it's sort of like the same in reverse for climate risk, and that's kind of what I wanted to talk about here today. So if we can just go on to the next, I talk about here about the damage onion. And so what that really means is, again, this is really specifically for the use case of banking here. For any particular house, let's just look at residential mortgages at the moment. For any different house that's on your book, not everyone gets damaged or feels that damage first. And so the first people that are going to, who's really on that outside layer of that damage onion, is the insurers. And so long as, and we'll go into it sort of a little bit deeper in a sec, but so long as there is insurance there, the lenders are still pretty good. But even if insurance is not there, then the next layer down is going to be the homeowners themselves, because again, not everyone feels that damage first. So the next layer down in that onion is going to be the homeowners' equity, and it sucks for the homeowners, and I get it. And banks really have that duty of care to help people prepare and help people understand what climate risk might mean for them. And that's a separate conversation. But really, just purely if we are optimizing for the shareholders of the bank, that is not yet your problem. It's only your problem if all these different, I suppose, buffers we like to talk about really fail. And so the first failure is insurance isn't there, and lender's mortgage insurance is not there. And then the damage is so severe that it actually goes through all of that buffer that equity provides, and that's when it's the problem of the bank. So if we can just keep going through. Sorry if I'm going so quickly, but I want to get everyone out of here on time. So again, not everyone feels the pain in the same way. Not everyone feels it at the same time. That notion of that onion and the damage onion. And so it's not just the when do people feel that pain, but it's also the like understanding what those payoffs of the different users have. And so just like there's lots of different ways to look at it, but I just really highlight on those first two. So the tenor or the timeline that you are on the hook for, really, if you want to look at it like that. Insurers have a 1 year typical, a 1 year rolling contract. And at the end of every year, the insurers are asked to renew their coverage, and so that's like, if you're an insurer, you have a 1 year obligation. The borrower has a different obligation. They have all of this. They have a lot of choice in how long they are exposed to climate risk through that house. And so they had the tenor of their obligation is until, I've said here, until they choose to either sell or they choose to default, as in the damage gets so bad that they hand the keys back. Whereas the bank, you're on the hook for 30 years. You don't really have any kind of choice in the matter there. And so that's that next layer down, that optionality, as in what agency do you have over the outcome? You don't, like going back to that onion, you, the banker, you are not the first layer, you're not even the second layer, you're the third layer, but at the same time, you have no optionality. So once you write that mortgage, you're on the hook for the next 30 years, unless the borrower chooses to walk away. So the borrower can choose to walk away in a number of different ways. They can either choose to sell a house, in which case you, the banker, are off the hook. They can choose to sell their house. But essentially what I'm saying here is the banker has no optionality, whereas the insurer has that optionality to not renew, and the borrower has that optionality to walk away in a few different ways. They can walk away, but you don't. And so what we say whenever we look at climate risk analysis is the most important thing, if I can take away one thing from tonight, is the way that you analyze the risk needs to align to the true risk profile on your portfolio. Right, so let's, Catherine, if we go to the next slide, please. So Catherine spoke about here, just like, this is, I'll get to the point in a sec. Essentially, Catherine spoke about the return periods of really trying to analyze how bad do we want to, when we analyze how bad climate risk could be, we kind of have to analyze how bad each of these different events are going to be. And we've got lots of different ways of modeling them, and which is, I suppose, Catherine spoke about the return periods, as in what is the chance of a 1 in 10 year flood versus a 1 in 100 year flood versus a 1 in 500 year flood. Obviously, they're going to be less frequent, but they're also going to be more severe. And so the way, again, getting back to the use case, trying to take this amazing science that the Mitiga folks do and Catherine does, and actually try to apply it to the use case here, which is how do we, I suppose, make sense of the true risk of our mortgage portfolio as it pertains to physical climate risk. And so if you were, back in the day, the first people to do this analysis were the insurance companies. And they did it for a really good reason. They did a great job for them. And they did it because insurance, as I've said, is the first, is it like at the bottom of the stack or the outer layer of that onion. And so they did it. And the way that the insurance cares about risk is they care about the one in one year event for anything they do. So long as they've got enough assets in that portfolio of theirs and they've received enough, which means they get enough lots of their premium, then they, like the law of large numbers says, all they need to care about is that 1 in 1 year event, like the average. And if they can do that enough times, then they're sweet. Whereas the banks don't care. The banks shouldn't care about the 1 in 1 year event. Like the 1 in 1 year event is a meaningless number because you know that doesn't get to you. It doesn't pierce through each of those different layers of that damage onion. So what we do is to model we need this to be severe enough, but infrequent enough to kind of make sense, to try to align the analysis to what our true portfolio risk is we try to dial out that return period. So we use a 1 in 100 year event. I can make an argument for a 1 in 50 year event. I can make an argument for a 1 in 250 year event. But I suppose one of the main outcomes is to look at the that there. Can we go to the next page, please? So then there's the integrated nature of risk. And again, we're trying to make this useful for the use case that we're talking about, which is analysing the climate risk on a bank mortgage portfolio. Yes, the science that Mitiga does is really important. It's that location-based. It is the looking forward to 2100. It is the multiple hazards, multiple return periods, all of that kind of stuff. Super, super, super important. But if you are trying to make that useful in a mortgage portfolio, you really need to look at other data sets. And so those data sets typically your more traditional credit focused metrics like LVR. It is which of your portfolios or which of your assets on your portfolio have lenders mortgage insurance? What are the valuations? Do you care about do you see most do, a higher value, higher LVR asset as more risky? Well, how can you overlay that data with the climate risk data? And so, if we can go down to the next, Catherine. So this is kind of how we do it. We take, I suppose, on the left-hand side there, you can see the map with all of the different assets. It's in a portfolio that we've got. It's just a dummy portfolio there, but at the same time, on the right-hand side, you've got, I suppose, this scatter plot that compares climate risk to LVR. And it's just one way, and we can do other ways as well. But essentially, it becomes less of a one-dimensional, and I know climate risk is not a one-dimensional thing, but for argument's sake, climate risk has a score, and it has so they call it 6 different scores for the 6 different hazards. Well, how might we then also have a look at, if we look at overlay that with LVR, then we can think about things in an area as opposed to just a single scalar. And then if we can go to the next one, we can have a look at what the histogram of the risk profile of your portfolio looks like. What proportion of our, let's if we say ratings are A through F, which is the way that the Mitiga data comes through it, or is one of the ways that it comes. You can have a look at what is the rating of each of the different assets or the proportion of your portfolio. And you can see that I suppose down the bottom there, when you've got the flood, most of the assets in your portfolio are going to have an A rating for flood, which is really good news. But some of them have the Fs, and those are the E's and the Fs, and those are the ones you really need to worry about. So if we can go to the next, please. We can have a look at, suppose, other different numbers. Again, dummy portfolio. How might we look at what proportion of your portfolio is exposed to I suppose if we give it a care about a rating of D and above, or an E and above, or an F, what are the different proportions of your portfolio that look at that? That we basically built that to align to the way that the CBA looks at their portfolio. I think we've got one or two more slides. So here's the final piece. I want to really just quickly talk about insurance. And in the green there, I've tried to, well, all of you will know credit risk. Like, it's the first thing I teach you in Banker School 101 is credit risk is the product of PD and LGD and exposure at default, right? That's pretty well standard. But how can we use that same sort of logic, that same sort of thinking for climate risk? So down below in pink, I've tried to sort of create a way of looking at it in a very similar kind of manner, but one that incorporates insurance. And so the climate risk, I mean, the probability of climate event, that's not just a single probability. There's a distribution of probabilities. You've got probabilities for fire and probabilities for flood and all that kind of stuff. So that's, I suppose, not a single number, but a distribution of numbers. So probability of a climate event times the loss given each of those different climate events. So we can model all of that kind of stuff under different conditions, under different scenarios, times the exposure at default. That is exactly the same as for the credit risk. And then there's one further term that I've added in here is 1 minus the home insurance coverage. Because at least in a very short term, for the next 12 months, if home insurance covered it, like this is the kind of the main, one of the main pieces I wanted to get across. If home insurance coverage is there, is in place, and is from a reputable insurer, and your coverage is good, if that's the case, then for the next 12 months, that home insurance coverage is equal to 1, which means that that term in your equation is equal to 0, which means your climate risk is 0. So if, I suppose, the one main message, just getting purely practical, this walks away from the theory and gets really to the practicality of the thing, is the one message that I can give everyone who owns or who manages a climate risk portfolio or a mortgage portfolio is ensure your guys have insurance, ensure your borrowers have insurance and be able to check it. Now, here's the funny part, or not the funny part, the tricky part. We can go to the next one. It actually aligns to APS 220. So all of you will have seen, I mean, all of you probably would have read these, but I've just got a screenshot there, just that last line there. The ADI must confirm that insurance is maintained, like insurance is present at origination and is maintained throughout the contractual term of the loan. Now, back in the 90s, I know that many of you on the call have been around for a long time in banking, and you would remember back in the 90s that every customer received a phone call once a year to say, have you got your insurance? Can you send it to me? Send me a certificate of currency. And that happens at origination. But back in the 90s, due to cost out, due to whatever reason it was, the market stopped checking, right? And despite the fact that it is here clear as day in APS 220, and I'll send this around so if people want to just sort of check that, but it is there clear as day in APS 220, everyone needs to do it, and yet no one's doing it. So Catherine, if we just go to the next one. So here's our solution for it. We are about to, as a bit of a plug, and apologies for doing plugs, but I mean, you got to do it at some point. We're going to be going out to I suppose, a lot of our friends in the banking market and trying to present to you this product called CoverProof AI. CoverProof AI is a combination, is an AI-based tool that you can present it to your borrowers, and you can say, please upload your certificate of currency. Your borrower will upload their certificate of currency to this tool, and the AI will parse the data in that certificate of currency and will present that to you, the bank, in a structured format along with the original certificate. You can see, actually, this is my certificate of currency just on that thing, but that's essentially the way we're going to be doing it. We'll be launching that in the next few weeks to friends and well, not family, but friends of Sustain2050 in the next little while. So please keep an eye out. I'll be reaching out to each of you separately to discuss that. So Catherine, can we just go to these last couple of slides? So I suppose here's the 101. There's 4 things you need to do really. Again, just for this use case of mortgage management. The first piece is an integrated view of risk across all of these different vectors. So yes, it is the climate risk and it's the damage expectations which we get from Mitiga, but it's also the traditional credit numbers like LVR and of course the home insurance piece that I've spoken to you about. We need to use those higher return periods. The second thing you need to do is once you've done your analysis of your back book and current state, what are you going to do about it? So you need to then develop a playbook. No playbook is going to be the same. No bank is the same. You each have different nuance. You'll each have different geographic, I suppose, concentrations you need to look at. But essentially, CPG 229 gives you a really good view of how to go through this. Look at it as, I suppose, the main pieces of risk appetites. So what are you happy with? What does a high risk property mean for you in the context of climate risk and credit risk? Again, integrating those two. There's a governance piece and there's a metrics piece as well. You've got to know what your risk numbers are. Third piece is integrate climate risk into your origination process. Just having a look at the time here, trying to get everyone out. There's quite a bit into that, but I suppose essentially the main message is it needs to be internally consistent with the way you manage your back book. So front book, back book, it's not the same, but it's got to be, I suppose, singing from that same hymn sheet. And the final piece, and again, I just spoke about sort of cover proof, is helping your borrowers to maintain insurance. That's it for me. I think, can we go to the next one? It's just sort of Q&A. I can see a couple of questions. I've got some here, I suppose, that I've sent over originally. But yeah, just a quick thank you to everyone. Jake, I don't know if we want to do Q&A, conscious of time, or if you want to just wrap it up.
There was one quick question.
Thank you. Yeah, we've got one question there. Catherine, do you want to take this from?
Yeah, I can just quickly answer it, considering it's clearly a question in the chat, asking about do we model surface flow movement of water? We don't currently model that, but we are expanding our flood offering. So this could be something we consider doing in the future. But right now, we are not modeling this. But because we have a multi-hazard approach, we're trying to do really the multi-hazard view. So really focusing on flood is a big job to do, but it's something, as I mentioned, we want to improve into the future to look at surface water flow perhaps.
Absolutely. And I would just add to what Catherine has stated there too. Mitiga's policy is certainly to work with our customers and our partners where there is a compelling need. So if you do have a use case where this is particularly important, then absolutely let's keep in touch. And that sort of brings us to the last slide here too, is if there's any questions, comments, follow-up, we can also, reach out to Joel, Catherine, myself, as well as Amir. But before we wrap this up entirely, I appreciate everyone has stayed into your evening here. Thank you so much for you doing so. Are there any other questions, comments that you wanted to throw out, either live or in the chat?
Can I make a comment? If there's no others. Yeah, just to come back on what Joel was mentioning, saying the climate data is two-dimensional. I know you didn't mean it in a bad way, but I totally agree that actually we have the information about climate hazards into the future, but actually what is the most important part is looking at sector specific. So including these other kind of factors, which are really going to be important when we're thinking about impact on the ground. So I'm sure, Jake, you'll agree with me. The point about working with partners who have expertise in areas which are wider and different to ours is really also part of our future plan, so that we can really get this climate data, make it into impact information and get it to the people that need it.
Yeah, 100%. And I would add one more thing actually too, just on Joel's comments with insurance. This is an area that we're expanding into very rapidly with our insurance partners and working hand in hand with the team at Sustain2050 around looking at the risk transfer element. So once you identify the risk from an insurance perspective, it's also important to understand what you do through adaptation measures but also potentially pushing that risk out to the capital markets through catastrophe bonds and other things. So that's something certainly we can dive into in greater detail, maybe in a follow-up session if those are interested, as we extend the discussion further. So
we've actually got one or two questions being typed at the moment. So do we hang on for a couple more seconds?
Yeah, no, absolutely. Happy to.
One question for me, just I suppose for Catherine. One thing we've been looking at is climate-driven migration. And currently we're seeing it go the wrong way. We're seeing it actually go from the south to the north of Australia. That doesn't kind of make sense, but I've also seen similar kind of things going on where there's a migration towards, say, Florida in the States, which would be one of the more highly affected places. So have you got any thoughts there, what we can expect to see?
Yeah, well, I think this is maybe linked to what I was mentioning about the impact of wildfires and property prices, that there's clearly other drivers which people are using when they're considering where they want to live. And I would guess maybe part of it is people not understanding the climate risk, perhaps. Part of it is that area has other attractions. There's other reasons why people want to go and live there. I mean, these are the only two kind of ideas that I think make sense. I would say that in general, humans, all of us, we don't have a good way of assessing actual risk. And especially if somebody's saying in 25 years' time, something might happen. I don't think people are maybe necessarily taking that into account when they're making a decision about where they want to live. So I think this is also about communication and about considering the other drivers and things. And maybe this also then comes down to politics in some cases as well. So I don't know, what's your thoughts on that?
I don't know. I think it's going to take an event. An event will change overnight, but I suppose at the moment it is illogical, but it's also people like nice weather, or like warm weather. So
yeah,
be that as it may, nice doesn't necessarily equal warm. But I suppose that's it. Anywho, can we just go through to the next pages so we can sort of put up contact details before we call it an evening. If you want to reach out to me or to Jake and Catherine's colleague Amir, guys, please take a screenshot for that. I will reach out to, I suppose, a bunch of you tomorrow or the next sort of day or two. But other than that, big thank you to Catherine, I suppose, in particular, and to Jake, and to everyone who has joined us tonight. I know it's a non-standard time to have a webinar, but we really are very grateful for having you on.
Thank you.
Appreciate
Thanks
it,
for the
everyone.
invite. Yeah.
Thank you all.
All right. Have a good night, guys.
Thanks, you too.
Bye.
Bye.